Today, we're talking about what's driving the markets and how investors should be thinking about it. Hello, and welcome to the April edition of the Hoffman Private Wealth Group podcast. I'm Todd Hoffman, Certified Portfolio Manager, Founder, and Managing Director at the Hoffman Private Wealth Group at Stewart Partners. Thank you for joining us.
Welcome to our April update. I'm Jenna Makras, Wealth Manager at the Hoffman Private Wealth Group. Today, I'll be asking Todd about the geopolitical factors driving the markets, the energy situation and its impact on inflation, interest rates, and portfolio positioning. Before we go into the podcast, I would like to take a moment to congratulate Todd on another recognition from Barron's Magazine, being named on the prestigious Barron's 2026 Top 1500 Advisors list. This list is for the best of the best across the country, and it's an even bigger honor to be named on both Barron's and Forbes in the same year. Todd, we are all so hugely proud of you.
Thank you, Jenna. I really appreciate it. But as you know, the credit goes to the entire team. I'm so proud of everyone on the team and how hard everyone works to help our clients. As they say, it takes a village to make things run smoothly, especially in these crazy markets.
So let's get started. Why should investors care about the current conflict in the Middle East with Iran?
Because it's just not political noise. It's directly impacting the markets and everyone's investments, both stocks and fixed income. The key issue is to focus now on the global energy supply. And according to the International Energy Agency, the Straits of Hormuz, which handles roughly 20% of the world's oil flow, is effectively closed right now. And this has created skyrocketing oil and gas prices.
So you're saying the instability of oil supply has driven energy prices higher, and this is impacting both equity and fixed income markets?
Exactly. Energy is one of the few inputs that touches nearly every part of the economy. When oil prices move, it feeds into inflation and central bank policy and equity valuations. And according to FactSet, crude has moved to the $100 to $115 plus range, with gains of 50 to 60% just in the last month. That's an extreme move. And according to the S&P Dow Jones Indices sector data, if you look at our first chart, you can see the inverse relationship between the price of Brent crude oil, which has surged approximately 60% from late February, while the technology sector has fallen about 18%, and the financials have dropped about 14%, and the consumer discretionary sector has declined about 16%. The only sector in the green is energy, and it's up more than 40%. And that inverse correlation is the key to the story right now.
I understand it impacting equities, but can you explain how this has impacted interest rate expectations in the U.S.?
Sure. Prior to the war with Iran, we'd been expecting the Fed to cut interest rates this year. But with oil prices rising sharply, the narrative has shifted from falling inflation to rising inflation, driven by energy. And as a result, the Fed is now unlikely to cut rates. And according to the CME FedWatch data, many analysts are predicting potential rate hikes. Higher interest rates increase the cost of capital and slow economic growth. And they reduce corporate earnings. And this has a negative impact on the price of bonds. And it leads to lower stock prices. And this is exactly what we've seen over the past 5 weeks.
Do you think markets will continue to decline, and what would stabilize them? And how long might this take?
Good questions. It all comes back to the Straits of Hormuz. The longer it remains closed, the higher oil prices are likely to go, and the more pressure on global economies and the markets, which is exactly why Iran wants it closed, to put pressure on Trump just to back off. The truth is uncertain. Depending on the news flow and who you listen to, it could be resolved quickly, or it could escalate with boots on the ground. My view is that it will likely play out over the next month, possibly even stretch into 2. It just depends on how committed Trump is to a regime change.
So once the current issue in Iran settles down, how long do you feel it will take before the price of oil comes back down?
Here's where it gets interesting and more positive. According to the U.S. Energy Information Administration, March short-term energy outlook, Brent crude is forecasted to fall below $80 per barrel by the third quarter and back to around $70 by the end of the year. And according to JP Morgan's global research, their base case is even more aggressive at $60. You can see both forecasts laid out on this chart. The data tells us that the oil spike is temporary and that the price of oil is expected to return to pre-Iran crisis levels.
What if the resolution with Iran takes a while? And are we just going to keep going down as we have in the last few weeks?
In the near term, we should get some positive news from the up-and-coming earnings reports. They're starting in about 3 weeks, and according to FactSet consensus estimates, analysts are projecting the S&P 500 earnings to grow over 12% for quarter one in 2026. It'd be nice to give us some good news and things to talk about for a change. And if we see these strong reports, which I expect we will, the good news from the earnings should help the companies we own as well as the markets in general.
Do you think the earnings are going to be good across the board?
Interestingly, some of the most compelling earnings opportunities are likely to emerge from the areas currently under the greatest pressure, most notably technology, where valuations have already fallen to multi-year lows relative to earnings. Historically, this is often how durable market bottoms begin to take shape. And while this doesn't necessarily signal an immediate surge, particularly with ongoing geopolitical uncertainties, it does suggest the formation of a meaningful floor and early stages of rebuilding investor confidence. Technology, in my view, is well positioned to deliver strong earnings, but it won't be the only source of strength. Market sentiment has swung too far in the negative direction, driven in large part by a relentless stream of concerning headlines. While this is understandable, this has caused many investors to lose sight of the underlying reality, and that is that the economy remains resilient and several sectors continue to perform exceptionally well.
The last chart showed oil coming down at a pretty quick pace. How do you see the recovery if the data in the chart is correct?
Well, let's look at chart 3. It shows our projected V-shaped recovery in blue. Based on the EIA price forecast and FactSet consensus estimates for earnings, once energy markets stabilize and assuming earnings remain strong, I believe we should see a sharp rebound led by the same sectors currently under the most pressure. The earnings catalyst in April could be the turning point.
So, to be clear, you are still saying you believe the blue bullish scenario will be the case for the markets in 2026, even with near-term volatility.
Yes, that's exactly right.
What's the bear case if things don't improve?
The bear case assumes an escalation in the conflict, potentially involving our military suffering losses of equipment or even life, causing us to go after a more significant infrastructure and damage in Iran, and prolonging the disruption in the Straits of Hormuz. That would likely trigger another major spike in oil prices from already elevated levels. And this would drive inflation higher and further slow global growth. Essentially, this is a stagflation scenario. And you can see the bear case illustrated on chart 3 as well. It's the dashed red line showing a more extended drawdown if the conflict would escalate.
This sounds concerning. Why don't you think that outcome is likely?
I believe the US and Israel have the capability to manage the situation militarily. Also, if conditions do continue to deteriorate, countries like India and China, who are friendlier to Iran and who are more heavily dependent on the Middle Eastern oil and natural gas, would step in and apply pressure on Iran to de-escalate the situation, pushing them towards negotiations if things did continue down this path. And here's what I want to emphasize. Historically, according to the S&P sector data, going back decades, the sectors that declined the most during the oil shocks tend to lead the recovery once energy prices normalize. That's where we see the opportunity.
So, Todd, what about the international markets?
According to FactSet data, all markets are now down for the year, except the international markets ex-US or excluding US, which are still up between 1 and 3%. This is simply because they were up more than the US prior to the most recent pullback.
Have we made allocation changes in the portfolios during this period?
Yes, we've been very proactive. We've reduced international exposure by about 60%, and we've reallocated much of this into US oil and natural gas. And these companies continue to move higher. We've also rotated out of financials and higher valuation technology and industrial names and into areas within technology where we have the highest conviction and earning strength and their ability to have a quick rebound.
And what are you telling clients right now?
First, we've taken meaningful steps to reduce risk, and we're prepared to do more if necessary. Second, portfolios are positioned with companies that should recover quickly once conditions improve. And importantly, this is a buyer's market. For investors with the ability to add, this is a huge opportunity. Finally, if anybody is feeling uncomfortable, we encourage them to reach out so we can talk about their situation.
Hey, you're closing with no jokes today?
I'll leave you with a kind of a trivia riddle. If you know the answers, email me and I'll tell you if you're right. Don't use Google. So here it is. Name 4 colleges that have an actual color in the name. An example would be the Red College, not the mascot like the Red Devils. The color is in the name of the college. I'm going to give you one hint. The hardest one is a small school in the Northeast who is just in the college basketball tournament. And by the way, all the colors are in the Crayola crayon box of 64. Good luck.
Thank you all for listening to the April edition of the Hoffman Private Wealth Group podcast. If you find this helpful, please share it with someone who may benefit from a thoughtful perspective on today's markets.
Thank you and goodbye.